All right, Chapter 15, Financing 2, Primary and Secondary Markets. So, in this chapter, we're going to describe various financing techniques, identify the sources of the real estate financing, where the money comes from, even though we did some of this already in the last chapter. Explain government influences on mortgage lending. We've also spoke about that. I even showed you a little video that explained a bit about how lending works. So, how does lending work in a nutshell? Here, once again, banks lend their depositors money with the intent of reselling those loans. They don't plan on servicing those loans for the next 30 years. You go to your local bank, you get a loan, they originate it. That's what we call it when the banks create the loans that they give to consumers for purchasing real estate. So they originate the loans. Now, how do you know if you qualify for the loan? Well, you've got to meet certain lending criteria. Now, the lending criteria are usually from some third party investor that's going to buy that loan from your bank after they originate it, soon after, anyway. So um, that's the part of banks originating the loan with the intent on reselling them to get their money back, plus some interest, and maybe even getting paid a servicing fee to continue doing the bill collections and doing the accounting. Now, most lenders are not portfolio lenders. Those are lenders that lend their own money and plan on holding on to the loans for the long term because there's a lot of money to be had in making them. Some lenders don't have that kind of money that they could have sitting up for 30 years waiting to get paid back. They um, so they'll lend money, they'll originate the loan, get the money back, lend money again, and keep repeating the process. Now, loans are originated in what is called the primary market or primary mortgage market. Those are where the loans are originated to the consumers to buy real estate. And then when those loans are resold to investors, which are just usually other banks or insurance companies or investment funds, that is what is deemed the secondary market or secondary mortgage market, either way. So the primary market lenders originate loans to the consumer to buy real estate, and they do that through mortgage bankers, brokers, and credit unions. You know the difference between a mortgage banker and a mortgage broker? Mortgage bankers only work for one lender, one bank. Mortgage brokers, they could work with many different lenders. And then you have credit unions, which are basically nonprofit banks. Now, Fannie Mae is the largest purchaser of loans in the secondary market. It's estimated that they buy one out of every 10 loans originated. That's a lot for one company. So you think they have a lot of influence amongst lenders when they're creating their um, lending approval practices, so those criteria for who qualifies for a loan? Yeah, because they know if they create the lending approval that that meets Fannie Mae's lending guidelines, they know somebody will buy it on the secondary market if it's not Fannie Mae themselves. Now, Ginnie Mae, she shares Fannie's last name there, so you know they're related. Ginnie Mae, think of her as Fannie Mae's ugly stepsister because she buys those ugly loans, those risky loans, the ones made to people with poor credit or things that you don't put down a lot of down payment, you know, the riskier loans. And then Freddie Mac, well, Freddie Mac purchases conventional loans on the secondary market. And conventional loans that are originated by primary portfolio lenders usually don't intend on reselling them. But hey, they are lenders, and sometimes maybe they have a project that comes up. They need to uh, liquidate some of their assets, so they sell off some of their loans. Who's going to buy them? They never originated them according to some third party's lending guidelines. Well, Freddie Mac will analyze them on a case by case basis and buy them. Okay. The primary mortgage market, once again, is where loans are originated to consumers. People get loans from savings banks, private investors, those commercial lenders, insurance companies, mortgage brokers, credit unions, pension and trust funds. Okay, that's the primary market. So here is how you apply for credit. You may want to take a screenshot of this. I put this slide together for you so it's easier to understand. The book has stuff peppered all over the place, but it's not even really giving you a good complete story. Um, so the first step when buying a house is you got to get a pre-qualification letter. Then you work towards getting a loan approval letter. And then it got to go through underwriting, and then the lender gives you a commitment letter committing to giving the loan. So the pre-qualification letter is just they run your credit score, they check that history, you tell them how much you make, what your approximate long-term debts are, and based on that information, they'll determine if they're going to grant you the loan. And then they issue a pre-qualification letter. Now, so far, the only thing that's been verified is your credit report. Now, if you want to get a pre-approval letter, well, now you supply the lender with all of your bank statements, pay stubs, tax returns. Now they verified all that information that you told them to get a pre-qualification letter. So you get a loan pre-approval letter. That's much better than a pre-qualification letter because now all the information had been verified. And then they put all that stuff through underwriting to get that approval letter. But you're still not going to get a commitment letter until you identify a property. And provided that nothing's changed in your job or your finances, the lender will examine all the information about the property. They'll look at the appraisal report and at minimum a wood destroying insect report to make sure the house isn't crumbling. And then they'll determine whether you pose a lesser risk to them so that they could grant you the loan. Okay, so this is the process of underwriting. Somebody at the lending institution called an underwriter examines all of your financial paperwork and then they determine whether they're going to grant you the loan. And they also evaluate the property, make sure it appraises for the purchase price. There's no wood destroying insects, and that you were able to obtain the certificate of occupancy or fire inspection, or the property owner did anyway. And then they grant that loan commitment letter, okay, committing to giving you the loan. And that's usually given about 40, maybe 30, 45 days from the date of the contract. Hopefully, if you got all the information into the lender on time. So here in the book is just what the highlight for the notes through the processes of underwriting. The lender carefully investigates the application information, studying credit history, how timely the applicant repaid debts, et cetera, and then they give you a loan commitment letter. Okay. You don't do the highlights, right?
I already did it
Oh, you,
in advance.
what do you do? You look at the slideshows in advance and you do all
Yes,
the highlights?
yes,
Oh,
yeah.
okay. Okay, good, good. Gets us through things a little quicker then. All right, so otherwise, I'm waiting here, to wait for people to do their highlights and their notes and everything. Okay, that's good. You get up on it. All right, so your credit score, the FICO score, that's the Fair Isaacs Credit Company. They created the credit scoring system. When you go to get a loan from a lender to buy a house, they run your credit with the three major credit reporting agencies: Experian, Equifax, and TransUnion. Now, a lot of people think they average out the numbers and then that determines what your credit score actually is. Well, that's not it. They just run a number from the three different agencies and they pick the one that's in the middle. This one's 720. So that's the middle number. So that's what your credit score is. That's how they determine it. Simple as that. No, no math, no
So we do
complicated
not
math.
have to remember the name of these
No.
agencies. No.
Experian, Equifax, TransUnion. No, you don't need to memorize that or anything. But you'll You'll learn them over time, not that it matters. These are just the three major credit reporting companies. When people's credit scores are run, that's where they're run from. And you're usually not the one that's running the credit anyway. So, okay, so qualifying ratios are used by lenders in determining if they're going to grant you that loan. Okay, so an example of a qualifying ratio is a DTI, a debt to income ratio. These are used to determine the maximum monthly expense for housing that the borrower could afford to pay. And what's your maximum monthly expense for housing? PITI. That's your principal and interest, that's your loan, plus your property taxes and your homeowner's insurance. And if it's a condo, they'd also factor in any HOA fee. Okay. But either way, an example of a qualifying ratio would be 2836. 28 would be the monthly income for housing expense, and 36 would calculate income on and all long-term debts. Sometimes lenders may allow up to 48%. It depends on the lender. Okay. Now that DOBI home buyer's guide, I shared this link with you the other day. I got a couple screenshots in the next slides which explain the the qualifying ratios, those debt to income ratios, how they work. But you need to know this for exam. An example of a qualifying ratio is a DTI, that's the debt to income ratio, used to determine what the maximum monthly expense for housing that the borrower could afford to pay, which is PITI. So here's that screenshot from that home shopping guide created by the Real Estate Commission. The DTI is one of the factors the lenders may consider when deciding how large of a mortgage loan you qualify for. First, they need to figure out what's the maximum monthly payment you could afford to make. And then based on that, they reverse engineer to find out what's how much of a loan they would give you. Okay. So to calculate your DTI, you add up your current monthly debts, your credit cards, car loans, etc. Divide it by your total monthly pre-tax gross income. And this is a way of showing how much of your income is available to make additional payments, like for a mortgage for the house. So lenders often call this the 2836 qualifying ratio. The first number, 28%, indicates the maximum amount of your monthly pre-tax income that the lender allows for housing expense. And the 36%, that includes all other expenses like you would have for housing, your mortgage payment, your taxes, your homeowner's insurance, etc. Now, if your ratio is higher than 2836, you may want to consider reducing or paying off some of your credit cards or other debts before doing a home search. When calculating and relying on your DTI to determine loan affordability, be confident with your numbers and don't be afraid to stick with them, because otherwise you may be overextending yourself for paying your bills over the long haul, and you may always end up struggling to get your bills paid. So it's an important ratio to stick by, even though some lenders can vary with this a bit. I tell you, this could lead to costly monthly payments and might cause financial hardships. Okay, I explained what the Federal Reserve is. The Federal Reserve is just the central banking system here in the United States. Lenders that want to do lending, they're all members of the central bank. Okay, so we call it the Fed, the Federal Reserve. So the Federal Reserve, contrary to its name, is not part of the federal government. It sounds like it is, but it's not. It's just all the nation's lenders are a member of this organization called the Federal Reserve. I showed you that video about the money as debt the other day, and that gave a good explanation of how lending works. So the purpose of the Federal Reserve is to try to counter inflationary and deflationary trends to establish economic stability and maintain sound credit conditions by altering the applicable federal rate, the AFR. The Fed is the central bank, and their job is to raise rates as much as possible for their member banks while trying not to destroy the economy in the process. So they have to bounce the rates down and up. They can't charge too much. So it's a delicate balancing act. And you see the current president, he was always arguing with the federal the guy that was running the Fed. Uh, he was raising rates, and then he even admitted he raised them too quickly, lowered them back down, you know, and it's like Trump was like, I told you that to begin with. You have to keep the rates a little bit lower for a little bit longer so that we get a little stronger, and then before you could raise them up. So the Federal Reserve is not a part of the federal government. It's a central bank created by Congress back in 1913 to establish economic stability, setting rates, creating new money, and fractional lending. This is when we went off the gold standard, too. The AFR is the applicable federal rate. So Fannie Mae is the largest purchaser of loans in the secondary market. Her stock symbol is FNMA. FNMA. You could even sound it out by reading the initials, right? FNMA. FNMA. She used to be called the Federal National Mortgage Association. That's where that symbol comes from. That stock symbol. Now, it's a shareholder-owned company operating under congressional charter. Yeah, because of all the bailouts and stuff, Fannie Mae is pretty much owned by the government right now until our economic system has been rebounded fully and that our government's been paid back the money for all those bailouts. So they're the largest purchaser of loans in the secondary market. They purchase 1 out of every 10 loans in existence. That makes them very influential with the banks, the local lenders. When they change their criteria for the types of loans that they're willing to purchase, the banks, the lenders, they usually change their criteria to match because they know that if they match Fannie Mae's lending criteria, they'll know they'll be able to sell their loan after they originate it to Fannie Mae or another secondary market purchaser of loans. So, conforming loan is a loan that meets Fannie Mae's lending guidelines. So, therefore, a non-conforming loan is one that does not, right? So don't confuse these with conventional loans, conforming and conventional. Conventional loans you get from portfolio lenders, and they don't conform to any third party's lending guidelines. Okay. Conforming loans are those that Fannie Mae is willing to buy. A lot of people confuse those two terms. Don't. And then Ginnie Mae, her stock symbol is GNMA, formerly the Government National Mortgage Association. Now you do need to know these. For some reason on the state exam, they give you some kind of question about which one of these are related. The answer is usually Ginnie Mae and Fannie Mae. Okay. I know there's one that's called Sallie Mae. Sallie Mae gives loans for student loans. That has nothing to do with this though. And then we have Freddie Mac. Its stock symbol is FHLMC. Yeah, you're not sounding that one out. This one you can. Ginnie Mae, right? You can figure what they out. But
So what kind of question you said comes in?
they could. I'm not sure. I forget. I mean, there's a lot of questions they could ask you about it, but usually they give you some kind of question about. They'll show you a bunch of different lenders, and they'll even make some up, and they'll say which of these are related. It has something to do with that, something along those lines, like which of these are related. It's an odd question. So Fannie Mae and Ginnie Mae got the same last name, so those are related. But they also may throw in there Sallie Mae, but Sallie Mae doesn't lend or buy loans for real estate. Sallie Mae is dealing with student loans. Okay. And loans that meet Fannie Mae's lending guidelines are called conforming because they conform to Fannie Mae's lending guidelines for the types of loans they're willing to buy. And Ginny, that's Fannie's ugly stepsister. She buys those risky loans. So non-conforming loans, if a conforming loan is one that meets Fannie Mae's lending guidelines, then what is a non-conforming loan? One that does not, right? Simple as that. Um, and conventional loans are those you get from portfolio lenders, or sometimes they reverse that. They say it's a conventional loan you get from portfolio lenders, or sometimes they say it's a portfolio loan you get from uh, conventional lenders. Yeah, either way, same difference. They're more flexible because they're lending their own money. They don't need to obey some third party's arbitrary lending guidelines. Borrowers with unusual credit situations, not bad credit, are ones that you get those portfolio loans for. Used to purchase properties that are non-conforming, like a mansion. Okay, it's greater than Fannie Mae's lending guidelines, perhaps, for purchasing a single-family house. Um, so you get them from portfolio lenders. Uh, a loan that is larger than one that meets Fannie Mae's lending guidelines is called non-conforming loan. It's a non-conforming jumbo loan because it's jumbo in size. It's huge, it's big, it's jumbo. Okay, that's the answer. You usually get some kind of question on exam about that. What do you call a loan larger than those that meet Fannie Mae's lending guidelines? Other than non-conforming, they're jumbo. They're jumbo in size, right? Okay, just some more of the same. We're just highlighting notes here. Primary conventional loans, Freddie Mac has the authority to purchase mortgages. They may buy loans that don't conform to Fannie Mae lending guidelines. And loans that are higher than the secondary market limit are known as jumbo non-conforming loans. You get them from portfolio or conventional lenders. Purchase money mortgage. Okay, now we're going to talk about types of loans here. Purchase money mortgage is a category of loans. It's any type of loan used to buy real estate. If you read the statement backwards, purchase money mortgage, mortgage, money to purchase. It's any loan used to buy real estate, and that includes seller financing, where they say the seller takes back financing. Okay, so basically, instead of getting a loan from a bank, you're going to be making mortgage payments to the seller. It's still a purchase money mortgage. Now, a reverse mortgage. A reverse mortgage is kind of the opposite. Usually you go get a loan, the lender gives you money to buy a house, and then you need to make mortgage payments to the lender. In a reverse mortgage, if you have a house that has a lot of equity already built up, you could get a loan against that equity. The lender will make monthly payments to you, paying the property owner back the equity that they have built up by paying down the loan over the years, and the home value is going up. You know what equity is. You have to have a lot of equity in a home to get a reverse mortgage. You have to pay it off at least 60 to 70% of it, to have at least 60 to 70% minimum in order to get a reverse mortgage. And then the lender makes small monthly payments to the borrower. Another way of saying that, reverse mortgage is where monthly payments are made to the borrower. Let's see, where the mortgagee makes monthly payments to the mortgagor. Okay, that would be a reverse mortgage. Okay, now this is a first loan. It is considered to be a first loan and not a second loan, because if you have a first loan still on your house and most of it has been paid off, and you go get a reverse mortgage, well, they will pay off any existing loans on the property so that they are the only loan. And then the lender will make monthly payments to the homeowner, paying them back their equity. Now, why do we have these types of loans? Well, so that seniors can live out their golden years in dignity and don't have to resort to eating cat food in order to get by. Or do I buy this medication that I need to live or this one? Because they don't have enough money, because they don't have a big retirement plan, because, or receive their full check like they for the rest of their lives, like a lot of government employees do, or teachers. You know, most people in society don't continue getting paid when they're no longer working for an employer. Okay, unless you have some sort of a pension, um, which many people don't have good pensions like that anymore. Most companies don't offer them, so you have to have your own 401k or IRA or what have you. Um, if you don't have a big savings, I showed you a video in the last chapter as well. Um, how long can you survive uh, if you have $1 million saved up and in your bank account? That's a lot of money. Most people don't have anywhere near that. But if you had $1 million saved up in your bank account, how long can you live in the state that you're living in? New Jersey ranked 49th behind California. I'm sorry, behind New York City. So, and with that, it was about estimated to be about 14 years. So from the time you retire, uh, you have 14 years before you drain that savings of $1 million. Okay. Um, so this is a way that somebody can get a monthly payments paid out to them so that they could still get by, you know? Better option would be probably to move out of New Jersey. New Jersey is simply unaffordable to live in, to especially to retire. Uh, and politicians are not working on making it any better. This Mickey Sherrill, she's even looking to get rid of independent contractor status. Where's that going to leave us as real estate agents? You know, they why would she want to get rid of independent contractor status? Well, once again, this is a political game. This is something that the Democrat Party has been pushing for quite a few years now in New Jersey, trying to get rid of independent contractor status so that everybody is basically part of a union shop. You know, their jobs, everybody's a W-2 employee and a member of a union. Why? Because then, they could get in bed with the union bosses and get them to support them. They give them money, they give them benefits, and one hand washes the other. Doesn't help the workers, just helps the politicians. Um, but that's actually a debate that's going on right now. If you've been watching the news at all, we'll see what she decides. Now, home equity loan is a form of second mortgage loan. This is where you go get a loan for the equity that you have built into your house, and they give you that full loan immediately. And then you have to start paying it back. It differs from a reverse mortgage because reverse mortgage, they make monthly payments of the equity, and you need to have most of your home paid off, and you need to be a senior citizen. This is only available to seniors. And with the reverse mortgage, when you uh, mm, let's just say all the equity is paid out to you. You live long enough that all the equity can be paid back out to you. The senior does not need to pay back the loan um, until they move or die. All right. And then it would be taken out. Then that property would be sold, and the proceeds from the proceeds, the home equity lender or that gave the reverse mortgage would would get their money, and any balance, if there was any remaining balance of equity, would go to their heirs. If the heirs wanted the house, well, they'd have to pay back that reverse mortgage in full. Now, the homeowner who's selling a residence, one property, and buying another, and were unable to do coinciding closings, well, they would need to be able to, they'd have to be forced to make a mortgage payment on two homes at once. And most people can't do that. So a solution is a short-term loan called a swing loan, bridge loan, or known as interim financing. Okay, so a bridge loan is to bridge that gap of time between the time you bought the new home and the time you sold the old one. So you could swing the payment on two homes in the interim. I guess that's where they get that terms from. A bridge loan, swing loan, and interim financing. Okay.
It's all the same. I mean, different names of
Yeah,
bridge
three
loans.
name. Oh, yeah, it's known as all three of these. Most commonly a bridge loan. Okay, but that's why I said so to bridge that gap of time between the time you bought the new home and the time you sell the old one, so that you can swing the payment in the interim. Okay, see how I put them all into one sentence there? So to describe what exactly it does. Okay. So we got that purchase money mortgage now. Here's my notes. Purchase money mortgage, read it backwards. Mortgage money to purchase is any loan used to buy real estate, including seller financing. It's a first mortgage. Reverse mortgage is also a first mortgage because they'll pay off any existing loans that may be on the property. You have to be at least 62 years of age or older to get a reverse mortgage. And you have to have a lot of equity. Most of the home needs to be paid off. You need to have at least 60 to 70% equity in the property. And then the mortgagee, that's the lender, makes small monthly payments, the mortgage payments. Instead of you making them to the bank, it's the reverse. The bank's making payments to you. Okay, that's why they call it a reverse mortgage. And it builds up debt. The senior does not have to pay back this loan until they sell the home or they die. When the senior dies or sells the home, the lender is paid back the money from the proceeds of that sale. Okay, here's two sources where you could get more information about reverse mortgages, reversemortgage.org and AAG Reverse. They're a lender. There are other lenders out there, but I usually put a bunch of their commercials here that explain what these reverse mortgages do. Now, this guy, he's no longer alive. Fred Thompson, he used to be an actor on like those what are those TV shows like NYPD? They had those and the special victim units and all those where he played the attorney, one of the bosses. But then he also became a senator in some state, so he was actually in Congress too. And then here he is as a spokesman for AAG for the reverse mortgage loans.
It just sounds too good to be true. I mean, you get cash out of your home, no monthly payments, and still own your home. There's got to be a catch, right, Jesse? Well, there isn't. It's like any other mortgage, only with a reverse mortgage, the loan's paid back when the last borrower leaves the home. In fact, reverse mortgages are based on a notion that President Reagan signed into law over 25 years ago in order to help seniors remain in their homes. They're simply an effective way for folks just like you to get the cash you need to enjoy your retirement.
Call 1-800-791-4075 now to receive a new free information kit, including a reverse mortgage guide and DVD, personal stories from people like you, and a brand new family guide for children and loved ones, all absolutely free with no obligation. With a government-insured, tax-free reverse mortgage from AAG, you always retain complete ownership of your home. Call 1-800-791-4075 to receive your free info kit today.
Now, the person who has the reverse mortgage, they still need to pay their property taxes and maintain the property.
If you've been thinking,
there's a couple of these commercials. The reason why I show a couple of them is because he talks a little bit differently about the benefits in each commercial, adding something different.
About financial options for your retirement, maybe how to provide some real security for you and your family, you really ought to consider a reverse mortgage with AAG. In uncertain times, it's a safe, effective financial tool. It's already being used by hundreds of thousands of other Americans. It allows you to eliminate monthly mortgage payments, pay some bills, or simply enjoy your retirement more. A government-insured reverse mortgage with AAG allows seniors to stay in their home and turn their equity into tax-free cash. To qualify, there are no credit score requirements, and remember, you continue to retain complete ownership of your home.
Right?
If you've
And then,
Hi, I'm Fred Thompson. And you know, if you're like a lot of folks out there lately, then finances might be a little tight. Well, maybe it doesn't have to be that way. Because if you're 62 years or older and own your own home, then join hundreds of thousands of other Americans who have used a reverse mortgage as a safe, effective financial tool. A government-insured reverse mortgage allows seniors to stay in their own home and to turn their equity into tax-free cash without any monthly mortgage payments. You ought to call my friends at AAG. They could help you or your parents right now. And to find out more is absolutely free. Call AAG today.
all right. I thought there was more to it than that. Okay.
Hi.
And since he passed away, now they have a new spokesperson here, Tom Selleck, and he explains a couple other features of it because a lot of people, put out rumors and stuff. Oh, that's just a way for the banks to get your property.
I know what you're thinking. I thought what you thought. Some things are just too good to be true. Just like you, I thought that reverse mortgages had to have some kind of catch, just a way for the banks to get your house, right? Well, then I did some homework, and I found out it's not any of that. It's not another way for the bank to get your house, and it's also not too good to be true. A reverse mortgage loan is a simple idea, really. You turn your home's equity into cash, and you pay it back when you leave the house. Most people use the money to pay off their existing mortgage or pay some bills, cover medical costs, even update their home. And, just as importantly, you still own your home. And you make no monthly mortgage payments. It's a loan designed just for older Americans, and it's helped hundreds of thousands to live a more stable, secure retirement and stay in the home they love.
AAG is the leader in reverse mortgages. Call us today for your free information kit. It will answer all your questions and help you decide if a reverse mortgage is right for you and how to qualify.
I know what you're thinking. I did too. I felt the same way. But I checked it out, and I found out a lot more. It's pretty simple. A reverse mortgage from AAG can give you the retirement stability you're looking for. Maybe you want to check it out.
If you're 62 or older and own your own home, give AAG a call to receive your free information kit. You'll receive the information you're looking for, as well as tell you how much cash you may qualify for. Call 1-800-816-7908 today.
AAG, bringing stability to your retirement.
Okay. That was the last one on that. So, we have a shared equity mortgage. Remember, I told you those loans that when people are religious people, it's against their religion to pay interest. Well, how do you get a loan to buy real estate? Well, here's your opportunity with a shared equity mortgage. The investor that lends you the money to purchase the real estate, they kind of become a silent partner in the ownership of it with you. So when you eventually sell that property years later, they share in the profit. They split the profit with you. Okay? So that's what's in it for them. Okay. Then we have a package mortgage. Package mortgage, it's a package deal. It's a loan that is used to buy real estate, but also chattel. Maybe like a furnished apartment, new construction that has, a washer and dryer and refrigerator included, or furniture. Okay, if that's the case, it'll be package deal. It's a package mortgage. Okay. Alrighty. Let's see. Then you have a blanket mortgage. Blanket mortgage covers more than one lot. This is often used by small builders and developers. They have one loan to buy the real estate, and then as they subdivide the property and sell off a smaller portion of the property off the larger one, the loan is paid back little by little. Normally, loans have an alienation clause that says if you sell the property, the loan needs to be paid back in full. Well, this has like a partial release clause. It's kind of like a modified alienation clause in it that basically says that as you sell off a smaller lot off of the larger one, you pay it back in the proportionate way as you sell it off. Okay, so we'll see. We'll have coming slides with better explanations and where I could show you something visually. Okay, and then a wraparound mortgage. I wrote here on the side, existing loan doesn't have an alienation clause. You could get a wraparound mortgage. A wraparound mortgage, if it doesn't have an alienation clause, that means when you sell the property, it does not need to be paid off in full. So a seller can sell their home and then offer seller financing to a buyer as long as they continue making mortgage payments to their existing lender, they're good. But the house does not need to be paid off in full when they sell it. So it would allow them to offer seller financing like that. That's called a wraparound mortgage, where you have two loans, a loan from the seller and the seller's loan to the lender. So one loan wraps around the other. They have nothing to do with each other. The new loan does not disturb the underlying financing that's already on the property that the seller has. It wraps around. So now those were the slides with just the highlights, and here are the slides with my explanations on them. Okay, what a home equity loan is. You does not pay off any current mortgage like a reverse mortgage would. It's just a loan for any equity that you have built up. You could borrow money against that. Then you have it is a type of second loan. And you could get that money paid out in a lump sum or over a period of time, like a home equity line of credit. It could give you a credit card and you could spend that equity as you like. And the borrowers must start paying it back right away, though. Bridge loans, well, that's when you're short-term financing, when you're buying one home before the sale of your existing home to help you swing the payments on both loans in the interim. Shared equity mortgage, that's where the purchaser needs financing to buy a home. An investor lends them money with no interest charge and becomes a silent co-owner. The partner investor in the shares in the profits from the eventual sale of the house or property. This is an option used by religious people that it's against their religion to pay interest. The partner with the investor could be the religious organization itself or its leaders, and they could lend the money interest-free. So this is the way it usually works in some of those religions where they're getting the money from their religious organization or leaders, or maybe even private investors of other sorts. So that's how it works. Package mortgage, once again, it's a package deal. It includes the purchase to finance real estate. It's a loan to finance the purchase of the real estate as well as chattel. What is chattel? Tangible personal property. That could include fixtures and appliance. That could include furnishings and appliances that are personal property, along with the purchase of the real estate, like a washer and dryer, furniture, a refrigerator. Okay, and here's just the explanation of the bridge loan just once again. It's short-term financing just meant for a period of time until you could sell your home. Usually not meant for more than 6 months. Blanket mortgage is a loan secured by more than one parcel of real estate. So basically, it is one parcel of real estate that you buy, but then you subdivide it into smaller lots, build houses on them, and sell them off one by one. Okay. Normally, this would require you to pay off a loan in full because it has that alienation clause that says when you sell a property, you need to pay back the loan to prevent it from being assumed, that loan. So, but a blanket mortgage has a partial release clause that allows you to sell off smaller portions off the larger lot and then pay it back in portions. So here's a graphic of that. So if you have you got a blanket mortgage to purchase this big lot and develop it. And then you subdivide it to 6 smaller lots. You build a house and you sell one of them. You'd only have to pay back in this instance 1/6 of the loan. And then as you sell off another one, you'd have to pay back another portion, and so on and so forth. Better understanding of that one? No? Good. Okay.
We do not have any other name for blanket mortgage, right?
No, it's just a blanket mortgage.
Partial release with partial release clause. Okay.
Yep. You could get a question on exam.
Okay.
What sort of mortgage loan has a partial release clause that says that when you sell off a smaller lot off of a larger one, you only have to pay back part of it? That would be a blanket mortgage. Okay. Or they could ask it other ways as well. And then you have the wraparound mortgage, which is a type of seller financing, where a seller offers a loan to a buyer to finance the purchase of their own property when they still have an existing loan on it that does not have an alienation clause that would require them to pay it off in full. This would allow the seller to transfer the ownership, selling without first paying off that existing loan. The new loan from the seller to the buyer does not disturb the underlying financing. The seller offers the buyer financing at a higher rate than their current loan. The buyer then makes a mortgage payment to the seller, and the seller continues paying off their existing loan. So there's 2 loans on the same property, but they don't touch or interfere with each other. That's why they call it a wraparound. They say that one loan wraps around the other. They have nothing to do with each other. They don't interfere with each other. Okay. Now, here's a little note about that because I get questions about these types of loans sometimes. And it said it's a good idea for the buyer using such financing to put a contract in place that would allow them to communicate with the seller's lender, so that in the event that the seller stops making payments to their own lender on their loan, that could jeopardize the buyer's interest in that property because it could get foreclosed on. So the buyer, this agreement, having an agreement that would allow the buyer to communicate with the seller's lender so that they could make the payments directly themselves if need be, would be a good safeguard. Now, an open-ended mortgage is one that never closed because it's open. This would allow for the buyer to get more financing out of that loan. They could draw on it like a credit card if the lender agreed to such an arrangement. So as you pay down the debt, you build equity, you could draw on it again and keep doing that because the loan never actually closed in the traditional sense. It's open-ended. Construction loan finances new construction. So it's a first loan and not a second. We're not talking about a home improvement loan. We're talking about a loan to build a house. That would be a first loan. They often carry higher interest rates, and the lender pays contractors directly in stages as the work gets completed. They don't just give you a bunch of cash and hope that you build a house and have no security for it. So in phases, they call it stages or phases. Phase one of the construction is when the foundation is built up to a certain point, as an example, you know, and then uh, the lender sends out the appraiser to check it and make sure that the work was done up to that point. Then the appraiser gives their okay, and then they release the funds to the contractor for doing the work and the suppliers for the materials. Then they start phase two of the construction, and phase two of the construction can say, okay, well, when the framing is done, and then they notify the appraiser comes back, inspects it, lets the lender know if everything was done at phase two, and then they release the funds. That's how it works. That's how most construction loans work. Okay, now we're going to talk about seller buyer financing agreements, like a sale leaseback. A sale leaseback is where the seller.
Victor,
Yeah,
so this construction loan is a first loan and not a second loan.
correct.
Yeah. And uh, this was also mentioned for purchase money mortgage. So is it the
Yeah.
same thing? It's the
No,
same
it's
thing.
no, it's just the first loan. First loan means that if it was the first loan on the property when there was no other loans on it. So it holds the first lien position in the repayment order. Okay. Um, a second loan is one where you already have a loan on your house and then you get another loan. Okay. Construction loan would be a first loan. A home equity loan would be a second loan. Uh, reverse mortgage would be a first loan because even if you have an existing loan on the property, they're going to pay it off so that theirs will be the only loan on the property. So making it a first loan. You understand what I'm talking about? What the difference is between a first and second loan? You could have
Yeah, I'm getting
first,
it.
second, third loan. Sometimes they're called, second loans and additional loans on a property. They're often also referred to as junior loans. Okay, you have senior, like Papa, and then you have junior. Okay, uh, so there has to be a senior for there to be a junior, right? So a junior loan is a second loan or third loan on a property. Okay. You good? You clear? Yeah.
Yes, I'm good.
Okay. Okay. And then let's see. So we have seller buyer arrangements. Here we have a seller leaseback. This is where a seller will sell you their property and then rent it back from you. Now, more common in commercial real estate. This is more common in commercial real estate when a business owner needs the money, they need the working capital for the business or for expansion purposes or some other reason. Instead of going and getting a loan, taking out a loan, they're sitting on a lot of money in the equity in their property. So they sell the property that they're doing their business out of. And this would allow them a lot more leverage to negotiate a favorable long-term lease for their business. So they sell the property to an investor and they negotiate a long-term favorable lease for themselves. So now they got the money to upgrade their machinery or for working capital for the business for other things, other reasons, or to expand the business in some way, maybe doing marketing or advertising. I don't know, the working capital for the business. Okay. So that's one example why you would do a sale leaseback. You sell the property and then you rent it back from the new owner. So another way of saying that is the buyer becomes the lessor and the original owner becomes the lessee. Then you have your typical seller buyer arrangements. Seller financing works like just like when you buy a property using a loan from the bank. The seller takes back the buyer's mortgage, and the borrower makes monthly payments and receives a deed right away, just as they would receive when doing the financing through a bank. A land contract is also a type of seller financing, except this is referred to sometimes as an installment sales contract, where the buyer makes monthly payments in installments and they wait for the deed. The owner does not give the deed to the buyer till they paid off the full amount owed or some other amount that they've agreed upon. Once they've paid it off up to that point, then they'll sign the deed over and give them the deed to the property. Okay. But until they do that, the buyer's been making, or the renter buyer has been making their payments towards the ownership of the real estate. They have something that's called equitable title. So they're more than a renter, but less than an owner, because those payments they've been making as a renter also go towards the ownership. So they're probably making higher monthly payments than a normal renter would, because that extra money goes towards the purchase. Now, don't confuse land contracts with ground leases. A ground lease is where somebody rents your land, your ground, and then they construct the building up. Then we have lease options. A lease with an option to buy. Any contracts that have option agreements must be prepared by attorneys. We don't prepare these. So somebody's buying a property and they have the option to purchase it at a pre-agreed upon purchase price by a pre-agreed upon deadline. Do they have to buy? No. But if they do decide they want to exercise their right to buy it at that pre-agreed upon terms, is the seller required to sell it to them? Yes. That's a lease with an option to buy. Now, the option itself is a contract all on its own. So there has to be something in value given in exchange to get that option, usually an additional payments. A lease purchase is similar to a lease option, except instead of having the option, you're definitely going to buy. The seller agrees to sell the property at a pre-agreed upon terms to a buyer to purchase it by a predetermined deadline that they're definitely going to purchase it by. It's not an option. They're definitely going to buy it. Okay. And so here's where we just have the notes on page 291 for land contract, also known as a contract for deed or installment sales contract. It's a type of seller financing. We went over it in chapter 11 on page 220. All right, Regulation Z, the Truth in Lending Act, implemented by Regulation Z, does not apply to cash transactions or business or commercial loans or loans for movable, where is it? Yeah, it also doesn't apply to home equity lines of credit, reverse mortgages, or land loans secured by movable dwellings, like mobile homes. Okay, let's see what else we got here. The Your Home Loan Toolkit must be given within 3 business days of the completed loan application. They put that in the mail within 3 days. Let's not skip this statement all the way here at the top, since we're now in chapter 15. The federal government regulates lending practices of mortgage lenders through the Truth in Lending Act, which is implemented by Regulation Z. The Equal Credit Opportunity Act, the Real Estate Settlement Procedures Act, and the TILA RESPA Integrated Disclosure, also known as TRID. Remember, I told you the CFPB, the Consumer Financial Protection Bureau, created, they took some old documents that HUD already had and they merged them. Some they gave new names to. Well, here's one that they merged a couple documents and then they merged them. Okay. So when is a loan application considered complete? When the borrower provides certain information to the lender. And that information would be the
Alien.
address of the property, aliens, the address of the property, the loan amount requested, the incomes of all the borrowers, their estimated property value, the names of all the borrowers, and their social security numbers. When they provided all that information to the lender, the loan application is considered complete, and then the lender is required to give certain disclosures within certain time frames. What are two things the lender has to provide to the borrower within 3 business days of aliens? Do you recall? 2 things. The Your Home Loan Toolkit and the loan estimate. So there has to be at least 7 business days between the delivery of the loan estimate and the closing. Now, there will be, because that's given way at the beginning where they're just applying for the loan. But sometimes loan estimates need to be regenerated for various reasons. We'll go over that on a different slide. What would trigger the requiring of reissuing a loan estimate? But either way, when a loan estimate has to be redone and regiven because there's changes in various things in the loan process, there has to be at least 7 business days between the loan estimate and the closing. All right. If you recall, Regulation Z implements the Truth in Lending Act. It requires the consumer be informed of the true cost of obtaining credit. It allows consumers to compare loan costs of various lenders and avoid the uninformed use of credit. It requires full disclosure and truth in advertising when talking about financing in an advertisement. If certain words are used in those ads, which we call triggering terms. It does not apply to business or commercial loans, cash purchases, home equity lines of credit, reverse mortgages, and land loans secured by movable dwellings. It applies to all kinds of financing to consumers, not just real estate. You ever see car commercials on TV? You know, when you see a car commercial on TV, if they talk about a monthly payment or a down payment or an interest rate, well, those are triggering terms that would trigger the full disclosure requirement under Regulation Z. Okay. Okay. Who is considered a creditor for Regulation Z? Anyone who extends credit more than 25 times in a year, or more than 4 times, or more than 5 times if real estate is the security. And here's the slide I usually give to everybody to study as notes. It's everything you need to know about Regulation Z. So everything with a little bow on it right here. Regulation Z implements TILA, the Truth in Lending Act. It requires full disclosure when talking about financing in ads. If certain words in the ad, which we call triggering terms, are used. Triggering terms are words used in an ad that would require full disclosure of financing terms and a qualifying statement to be added to avoid indiscriminately promising financing to anyone who sees the ad. We have to discriminate when advertising and offering financing. You have to say to those who qualify or to a qualified buyer, and then disclose all the financing terms. If any of these triggering terms are used in an ad, if you mention an interest rate, a payment amount, a down payment amount, or the term, like the number of payments, well, now you're talking about financing. So full disclosure is required.
There can be a question related to the triggering terms, that what are the terms, or Are
Yeah.
these the only terms, or there can be an
No, these are the only triggering terms. If in an
okay.
advertisement you mention an interest rate, a payment amount, a down payment amount, or the number of payments, the terms of the loan, then full disclosure is required. You have to put one of these phrases in the advertisement to those who qualify or to a qualified buyer, because now you're discriminating. You're saying, hey, this doesn't apply to anybody that sees this ad out there, only to those who qualify. You follow? That's what I mean by discriminating. You're not offering this advertising to anybody who sees the ad. It's only to those who actually qualify for the loan. And then you need to also disclose the APR. That's different. The annual percentage rate's different than the advertised interest rate. I'll explain why in just a second. You have to disclose the down payment amount if one is required, and the term. What are the terms? The number of payments. And if you do not follow these disclosure requirements as Regulation Z requires, the penalty for violating administrative order of Regulation Z is $10,000 per day that advertisement is out there in the public's eye, the public domain, and violating the law. And willful violation is a misdemeanor crime, punishable by $5,000 fine and 1 year in prison. Okay, so what's an APR? An APR is the annual percentage rate. It's always a little bit higher than the advertised interest rate because it includes all those one-time non-reoccurring fees associated with getting the loan. Like for real estate, an application fee, an appraisal fee. These are not fees that are reoccurring, but they are fees associated with getting the loan. So if you were to factor all those one-time non-recurring fees as are required in order to get the loan into the loan and over the lifetime and then break it down over the annual, it would raise the interest rate just a smidgen, just a smidge. So that would be the APR. The APR is the interest rate, plus you're factoring in all those one-time non-reoccurring fees associated with getting the loan. That's why it's always just a little bit higher. Okay. Don't worry, we don't need to do those calculations. That's a lender that does that. Okay. Any questions about Regulation Z?
No, I'm good.
Okay. Well, it also does not apply to business or commercial loans or cash transactions, reverse mortgages, land loans for removable dwellings either. Okay. Now, on your exams, they may mention it by name, Regulation Z, or they may just explain it, the situation, and you then need to explain what is required of it. They may not even mention it by name, but then again, they may. So you need to know Regulation Z and that it implements TILA, the Truth in Lending Act. So there's a 3-day right of rescission in Regulation Z for loans to refinance real property. But there is no such right of rescission for loans to buy real estate. Because at the closing, when you buy real estate, money goes to the seller's existing lender to pay off the loan. It goes to pay the realtor's commissions. That money gets split up so many different ways. It's impossible to claw it back. You're going to get the money back from everybody. So that's why there is no right of rescissions for loans to buy real estate. Now, here are, once again, those triggering terms, explanation of the triggering terms. And here are what those triggering terms may look like in an ad. If you say 30-year loan available, well, you're talking about the term. If you mention the payment, monthly payment, payments of $1,432, including principal and interest, or only 5% down, well, you're talking about down payment. right? Now, these are terms that would not trigger the Regulation Z disclosure. If they're more broad, financing available, terms negotiable, owner may finance, assume, that means take over a 5% APR loan. That you're not quoting an interest rate, you're quoting the APR, but you're telling them that it's assumable. They could just take it over. That's different than getting a loan. Okay. Attractive financing, whatever that means. And 400,000 mortgage available. Well, that's not a month. That's not a payment. That's a total. Okay. And then you need to use the words to a qualified buyer or those who qualify so that you discriminate in who sees the ad. And here's those penalties once again, up to $10,000 a day, or not up to, but $10,000 a day for each day that ad is violating Regulation Z in the public domain. Okay. And you have all this already in your notes, right? Okay, ECOA, the Equal Credit Opportunity Act. I spoke a little bit about this in chapter 4 when we were talking about discrimination. ECOA was passed in the 70s. This was mainly to protect women against discrimination. They may have had trouble obtaining financing because, you'd have the guys that would tell, you go in for a car loan or the loan to buy a house. You're a woman, you could have a job. Now you want to do it on your own. Maybe you're not married. Maybe you are married, but you want to go and buy these things. And you go to the car dealership or to the mortgage lender and they'd say, all right, little lady, why don't you go home and bring the man out so that we could talk business, and you could do your things. Maybe you go shopping, that kind of nonsense. Okay. Well, that stuff was pretty common because that's the way that people often thought and acted back then in the 70s, sexist. Yes. So this was a law passed to protect women from such sexism like that. So, of course, it applies to all protected classes, but it was created to protect women when trying to get loans. So it applies to lenders and others granting, arranging, or denying credit to consumers based on their credit scores or reports. It's originally created to protect women who were denied loans because of their sex, assuming they may not work outside the home. People denied credit must be given a free copy of their credit report and an explanation for the reasons of the denial of their credit. And it prohibits discrimination on the basis of any of the protected classes. For landlords, using tenant screening or grading reports instead may be a good option. However, with some recent changes in the laws here in New Jersey, we got that FCHA, that Fair Chance in Housing Act. It kind of makes criminals a protected class. Okay, we could do the screening for the credit, your bills and your payments, and maybe even do employment checks. But you got to be careful about denying people because if you're doing criminal background checks too, you may not be able to do them except in certain circumstances. So new changes in the laws would make for an owner and the real estate licensee liable for discrimination if the screening service they use doesn't comply with new changes in New Jersey law for approving or denying tenants, which may consider criminal background checks in addition to the credit check. See, tenant screening scores or grading reports took into consideration their credit, their employment, their debts, but also their criminal background. So see the latest Attorney General's memorandum where we already talked about the FCHA, that Fair Chance in Housing Act, discussed in Chapter 4, which essentially makes ex-convicts, who are now referred to as system-involved people, they soften the language up a lot for that, a protected class. Okay, RESPA, the Real Estate Settlement Procedures Act. Should have this highlighted in your book and study it. What does RESPA stand for? Real Estate Settlement Procedures Act. And what is the purpose of the RESPA closing statement? It used to be called the HUD-1, now it's called the CD. But what is the purpose of it? The RESPA settlement statement, formerly called HUD-1, was replaced by the CD. It explains all the final actual settlement costs to the consumer and must be provided at least 3 days before closing. At the beginning of the transaction, an estimate of those costs are given, and that's called the LE, the loan estimate, formerly the GFE, the good faith estimate. And that must be given to the consumer within 3 days of alias, the loan application completion. In certain circumstances, a new loan estimate must be reissued to the consumer, triggering an additional 3-day waiting period before the consumer can close. And there must be at least 7 business days between the time the LE is issued and the CD, the closing disclosure, is given, which contains all the actual closing costs and must be provided at least 3 days before the closing. So you need to know what the old document was, what the new document is replacing it, the timeline it needs to be given. Okay. So what is the purpose of the RESPA settlement statement? To ensure the buyer and seller in residential real estate transactions involving new first mortgage loans to buy the real estate have knowledge of all settlement costs. That's it right there. That answers one question if you got that question. What is the purpose of the RESPA settlement statement? To make sure the consumer is aware of all the closing costs. Okay, but here down below, this is a great definition for what the original settlement statement was called. It was called HUD-1. It was replaced by the CD. And when does it need to be given? And then the LE is given at the beginning of the transaction, what it used to be called, when it needs to be given. Okay.
So it's to make sure that the consumer is aware of all the settlement cost, closing cost.
Yep, that's it. Okay, and these are the timelines and what the old documents were called and what the new document is.
Yeah.
Now, the HUD-1 can still be used today on transactions that don't require the new CD. You know, like all those ones where they say does not apply to refinancing or reverse mortgages or, loans used to purchase land with removable dwellings. Well, you could still use the HUD-1 because it was an easier document to fill out to manage the finances for the closing. So in those circumstances where CD is not required, you can still use the HUD-1 for convenience and ease and commercial transactions. Okay. All right. So RESPA, here's another slide I have with everything you need to know with page number references where you can look it up. RESPA is the Real Estate Settlement Procedures Act. It's a federal law to ensure the buyer and seller in residential real estate transactions involving new first mortgage loans are aware of all the settlement costs. The parties in the transactions must have knowledge of all the settlement costs for every penny in the transaction. It does not apply to cash transactions, commercial loans, mobile homes, or reverse mortgages, or home equity lines of credit. In those cases, you could still use the old HUD-1, which used to be the HUD-1 RESPA statement. Now it's the CDs, the new settlement statement. So it's illegal for anyone to get paid in a real estate transaction if it's not disclosed on the RESPA settlement statements. Now that's the CD, the closing disclosure. Formerly, it was called the HUD-1. The document was not just renamed, though. It was modified and changed. Here we go. The loan estimate is an estimate of the closing costs at the beginning of the transaction. It replaces the good faith estimate. must be given within 3 days of the completed loan application, aliens, and 7 days between the time the loan estimate is issued and the closing. Certain changes may require reissuing the loan estimate and triggering an additional 3-day waiting period. The CD, the closing disclosure, is accounting for all the actual final closing costs, as opposed to the loan estimate at the beginning, where they're just estimating the closing costs are going to be at the beginning of the transaction. There must be at least 3 days before the closing, and the CD must replaces the HUD-1 RESPA settlement statement. And buyers should compare the loan estimate that was given at the beginning of the transaction to the CD, the closing disclosure, which is given at the end. If the costs vary beyond certain limitations as defined by TRID, the lender is responsible for covering those costs. They cannot exceed certain limitations. I'm not sure what they are. Maybe 10%, let's say. Okay. You good? Need a screenshot or anything? Or you good? Okay. Great. So what is TRID? The TILA RESPA Integrated Disclosure. So the Consumer Financial Protection Bureau, the CFPB, merged and modified existing forms HUD created. Lenders are responsible for delivering documents within certain time frames, and lenders are liable if certain costs exceed tolerance limitations imposed by TRID, like we just spoke about on the previous slide. You have to compare the estimated cost on the loan estimate to the actual cost on the CD, or at least the borrower should. Now, TRID rules do not apply to home equity lines of credit, loans for movable dwellings not attached to real estate, reverse mortgages, cash transactions, and commercial loans. Okay, this is on page 294. Okay, so lenders can charge fees only after the loan application is completed. Otherwise, I don't think they could charge more than $25. So the lender may charge additional fees, such as a loan application fee and an appraisal fee, only after the consumer indicates an intent to proceed. And this is done by submitting a completed loan application, or aliens. And that's when all this information had been provided. You see it says aliens straight down. And like I said, the loan estimate replaces the good faith estimate. It must be provided to the consumer within 3 business days, or put in the mail within 3 business days of the completed loan application, or aliens, along with the toolkit for comparing and shopping for loans. Here are the changes that would trigger reissuing of a new loan estimate. I got them on another slide. So here's just where you would, this is the highlight slide. My next slide, I got the same stuff here, but with a little further explanation, which is a good tip I put in here for you. So if you didn't get it, and I also show you beyond certain loan tolerances. Well, actually, they wrote it here in the book too. Okay, but not this tip. This tip is from me to you. Okay, so here are the situations where a new loan estimate would be required to be regenerated. If the consumer requests a change in the loan or the amount of their down payment. If the appraisal comes in higher or lower than expected. If there were changes to the borrower's credit score or their debts. Here's a little tip. You, as the real estate agent, should inform your buyer clients that you work with not to make any large purchases, charges, layaways, or leases, or changes in employment until after closing, especially if they're changing to a different type of career than they currently had. The lender could not document the borrower's pay, overtime, bonuses, tips, and other income. Costs charged for services to the borrower that they couldn't shop for. A new LE would be required to be issued for interest rate change because the borrower didn't opt in for a rate lock or the rate lock expired. A prepayment penalty was added. I know New Jersey, no prepayment penalties are allowed. However, that's for institutional lenders. Private lenders, it doesn't apply to. Loan product was changed, or the APR increased beyond allowable limits. That's 1/8 of a point for fixed rate loans or 1/4 of a point for adjustable rate mortgages. These are the situations that would trigger the reissuance of a new loan estimate. And there has to be how many days between the time the loan estimate is issued and the closing?
7 days.
7 days. And it would add an additional 3-day waiting period. Yeah, go ahead. What was your question?
What do you mean by layaways?
By what?
Purchases, charges, layaways.
Layaway. Yeah, a layaway. When you buy,
Layaway.
okay, so when you buy something on layaway, it's like you put a down payment on it for them to hold it for you, and you're going to come back and buy it. It's still on your credit as a hold. It shows on your credit report still. When you lay away furniture, it's often something you do with furniture. You could purchase furniture on layaway. It's like a hold. You're asking them to hold it for you. You put a little money down and you ask them to hold it for you. Okay, so here's another slide with the timelines and the different documents. Aliens, LE, toolkit, and the CD. I got them all here on one slide again. Okay. And then here we just highlighted the notes about what the loan estimate is, what it replaced, and the CD and what it replaced. Loan estimate replaces the GFE, CD replaces the HUD-1, and the timelines that they must be given to the consumer. But we also have here a definition of a business day, because we have to give all these or the lender needs to give all these documents to the consumer within certain time frames. And so how do these time frames, how do you count time? What is a business day? We keep saying business day. Well, there's 2 definitions that exist for a business day. There you go. One definition is a business day is any day that the lender is open for business. And the other definition is any calendar day except Sunday and federal legal holidays. So depending on the creditor, the lender, Saturdays might or might not be considered. So there you go. Clear as mud. What is a business day? Depends. All right, here's a little goof video that I found at some real estate agent. I think she's in Canada. But anyway, it still applies. A real estate agent explains some of these issues, like I gave you on tips on 2 slides ago about putting stuff on layaway and doing any large purchases, counseling your buyers that you're working with. But she also goes about showing properties and how other people view how we do our business. It's a cute little funny video. That's the only reason I got it. Let's check it out.
Gemma, I've really been thinking about getting into real estate.
Right?
It seems like you've got such a flexible day. You
Yes.
can drive around all the time and make your own schedule.
Right.
It seems like fun and easy.
Jamariquette, bonjour.
Just wondering, can we see 8 houses tomorrow morning?
Tomorrow morning as on Christmas Day?
Did you hear that? Somebody called up and said, can we see 8 houses tomorrow morning? And she's like on Christmas Day? Yeah, people do not value your time at all. You need to know when to pick up that phone and when to just let the machine answer.
Okay, I gotta pull up this address. Oh, come on.
Have you ever experienced that where you're searching for a property, but the property is so new it doesn't even show up on Google Maps or Yahoo Maps or whatever mapping system you're using? Yeah, that's a problem we experience often in real estate. And it could be years later that those properties have been sitting there already, but the mapping systems still have not been updated. So you can't find the property. You gotta call up and find out where the hell is this located. I can't even find the street. It doesn't show up in any of the GPSs. Okay, what's going on here? Those old lock boxes like she was showing here, this is an old lock box where you press buttons on it to try to open it. These are still being used by a lot of agents, and they must be used on certain types of listings like HUD listings. Actually, they use padlocks, so you need the key now. But the types of properties where agents are still using these types of padlocks, these locks that have the key inside, are notorious in the wintertime when they get a little water in them for freezing up and you can't open them. So that's why she's running at it with a sword and a hammer and and a shovel, I think.
I mean, you get to look at all these amazing houses, and everybody's staging right now, right?
Yeah, most of them do. And this is the master bed. I'm sorry, we're not going to see this.
Yeah, that happens. I've walked in on plenty of times when that was happening. And you could be, this is why what I do is when I'm showing houses, I knock on the door, and I knock on the door. I don't just ring the doorbell, and I knock on the door and rap on the door several times. Nobody comes down. I use the key. I open the door, and I don't open the door all the way. I just yell, "Realtor, realtor, hello, realtor." And it's also for in case there's a dog or something there. But, you also want to make sure you make enough noise. So it's for safety reasons. Make sure you don't get attacked by a dog by just opening the door because there's a lockbox and you made an appointment. Somebody may have forgotten to lock up the dog. You don't want to get hurt or have your clients get hurt. That's a lawsuit waiting to happen. But then as you start moving through the house, you start going upstairs or downstairs. I suggest you yell, "Realtor, hello, realtor." Keep doing it as you're showing the house, And I do that, and I still had this situation where I was yelling, "Realtor, realtor," and I don't know, maybe they wanted somebody to walk in on them. Who the hell knows? But it does happen. I'm telling you.
I mean, you get to work with people, and I love people. I'm a people person.
Gemma, we have some exciting news. We're pregnant.
So we have to stop looking at 2-bedroom houses and we have to start looking at 4.
But we have the same budget though still.
All your clients have to do is love the house, and then they buy it.
Gemma, this house is perfect.
Right?
Yes, totally. But I feel like there's a but.
But we've only seen 87. I think that we should see some more. It needs to be perfect.
So we did it. We found you the perfect house. This house is at market value. Okay, so they're asking $648,000.
So let's offer them $400,000.
Yeah.
Okay guys, we have received the home inspection report. So everything is good. We can now remove our conditions.
You said if we find something wrong, we could walk away or negotiate with them, right?
Right? What is wrong?
Well, the lights were too bright.
The paint?
I didn't like the doorknobs.
It's just the atmosphere.
And the windows were kind of dirty.
It's really messing with my feng shui.
I get to see your social media account and all of those happy people. I want to make everybody happy.
Guys, picture! Hey guys, we're happy. We just bought a house. Take a picture. Yay, cheers! Cheers!
So that's fun. But that's not a thing?
But
No, thank you.
You'll see, it'll be great.
No, thank you.
I mean, it's an easy job, and you get paid so well.
Okay, guys, so the process is done. So from now on until closing, make sure that you're not buying anything, any big purchases on credit.
Obviously.
Okay, so no boat, no vacation, no cars.
Come on, Gemma, we're not dumb. Gemma, what do you think of our new car?
Isn't it great?
You paid cash, right?
We got a wicked 1.5% rate.
Yes, you know what? Honestly, I think you're going to love it. Would you like me to get you my books?
Sure, yeah.
Yes, do that.
Wait, you have to study all this just to sell houses?
All right. I thought it was a cute little thing. It shows some of the issues that we come across often, real life experiences and issues that we come across in real estate when showing property, when coaching buyers, having to deal with nonsense where they, well, the windows were dirty or there's a stain in the carpet. Well, those are things that you notice. Those are cosmetic issues. You can't back out of a contract or change terms because of a cosmetic issue. You've seen it when you walk through the house, So, but these are common issues that we come across. Okay, so this is the end of chapter 15. Let's do the key terms for chapter 15. Doesn't look like you're going to have any help today to answer these questions. Not like anybody's ever answering them anyway. So, right, you seem to get them all the time. Are you ready?
Yes.
Okay, let's see what you got. So page 301, key terms 1. Mortgage covering more than one parcel of real estate.
Blanket.
Correct.
Mortgage.
One is A. A mortgage covering both real and personal property.
Package.
Yeah, it's a package deal.
Mortgage.
Yep. Package. It's a package deal. It's a package mortgage. So 13 is B. Cooperative organization for members who save and borrow. It's basically a nonprofit bank.
Credit union.
Yep. 3 is C. A privately owned corporation that sets standards and buys mortgages.
Fannie Mae. Fannie
4
Mae.
is D. Yep. Fannie Mae. Correct. The Federal Home Loan Mortgage Corporation warehouses packages of mortgages originated by member savings and loan associations.
Freddie Mac.
You just look at the beginning, Federal Home Loan Mortgage Corporation, look at the initials, FHLMC. That one you couldn't sound out. That's Freddie Mac. Correct. 5 is E. What about the Government National Mortgage Association mortgages for investors?
Ginnie Mae.
Ginnie Mae. 6 is F. Additional financing for a homeowner, usually a type of second mortgage.
Home equity.
7 is G. Home equity loan. Loans with interest only, typically for less than 6 months.
Bridge loan. Bridge swing interim.
Well, there we go. Interim is what they have listed. Yeah, but it's bridge loan, swing loan, or it's also known as interim financing. So interim financing. 8 is H. Oh, sorry about that. 8 is H. A loan higher than those usually bought in the secondary market. What do we call those larger loans?
Jumbo.
9 is I. Agent who makes real estate loans, usually for one lender. You should probably write that at the end of the letter J, usually for one lender.
Usually for one lender. Just a second.
Yeah, because that makes a difference. Agent who makes real estate loans, usually for one lender.
Mortgage banker.
Yep, the mortgage banker, correct. Agent who brings together the lender and borrower in exchange for a fee. And they can work with
Mortgage
many
Mort-
lenders.
broker.
A
Mortgage
mortgage
broker.
broker, correct. 11 is K. A mortgage that provides possibility for further borrowing.
Open end.
Open end, 12 is L. Straight loan for short building period.
Construction loan.
2 is M, the construction loan. Okay, now key terms 2, at the end of letter A, write to buy real estate.
Loans to the public to buy real estate.
Yep, right at the end of that line, to buy, loans to the public to buy real estate.
Okay.
Then next to letter C at the end of the line, it says seller financing. Put a slash there and then write any loan to buy real estate. Any loan to buy real estate. Slash any loan to buy real estate.
Okay.
And then go down to letter J and write TILA at the end of the line in all capital letters, TILA. TILA.
It's already written, Truth in Lending Act. Okay,
Yeah.
short form.
Well, just so
Okay.
you know the abbreviation, because sometimes they won't say it. They'll give you an abbreviation. They'll call it TILA. More often than not, it's just referred to as TILA. Okay, so lending institutions that make mortgage loans to the public to buy real estate.
Primary mortgage market.
Correct. 2 is A, primary market or primary mortgage market. Loan not intended for resale on the secondary market.
Portfolio loans.
Yes, 1 is B. Seller financing, any loan to buy real estate, including seller financing.
Purchase money mortgage.
Yep, purchase money mortgage, correct. 3 is C. An arrangement by which a seller becomes the tenant.
Sale lease back.
Yep, the sale lease back. The seller becomes the tenant. 7 is D. Process of deciding whether to make a specific loan. What do we call that process? Where the lender evaluates the finances, the appraisal, the inspection, whether they're going to decide whether they're going to give you the loan or not. What do we call that?
Underwriting.
It's called underwriting, correct. 11 is E. Words in an ad that require full disclosure of financing conditions.
Triggering terms.
Triggering terms. 9 is F, correct.
Yeah.
Triggering terms. A percentage of income borrower may spend on housing expense.
Qualifying ratio.
Yes. And an example of a qualifying ratio would be the DTI, the debt to income ratio. But yeah, it's called a qualifying ratio. So 4 is G. Percentage, what am I reading? Mortgage in which the lender sends regular checks building up debt. Reverse mortgage. 6 is H. Yeah, because it's the reverse of the normal. Lender doesn't usually send you checks. You send them checks and payments. So 6 is H, reverse mortgage. A loan in which investor shares payments and profits.
Loan in which investor shared mortgage.
Yep,
shared equity mortgage.
Shared equity mortgage. 8 is I. Implements the Truth in Lending Acts.
Regulation Z.
Regulation Z. 5 is J. Regulates consumer loans.
Bye-bye.
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 Consumer loans means conforming loans.
No, regulates consumer loans. What regulates consumer loans?
TILA.
Truth in Lending Act. Yes, TILA. 10 is K.
Oh, it's written.
Larger loan that does not disturb underlying mortgage.
Wraparound.
The wraparound mortgage. 12 is L. Merges the TILA and RESPA disclosures.
TRID.
TRID. The TILA RESPA integrated disclosure statement.
Disclosures.
Correct. 14 is M. Detailed loan costs. Where can
Loan
we find all the
estimate.
detailed loan costs?
Loan estimate.
In the loan estimate. 15 is N. And required items before the lender can proceed.
Aliens. That's the
Alien.
only option, but I couldn't understand this. Required items before the lender can proceed. Yeah, okay.
Yeah,
Alien.
the lender can't go forward until you completed the loan application,
Yeah.
provided certain information to them. So 13 is O. And that would be aliens. And that concludes chapter 15. So